Ann and Shane, thank you for joining us. Ken Zacharias with CLA, thank you for joining us. Today we are going to simply be talking about the tax advantages of owning real estate when you're a high earner. So Ann has been crushing it with sales and commissions, and she's starting to ask the question about, what are some tax advantages I can use to offset and pay less in taxes legally through using real estate tax advantages. The tax advantages that are legal for us to use, how do we, take advantage of them? And I have my personal mentor, Ken Zacharias, on this call. Ken has been guiding and mentoring me since I was a pup in the real estate industry. He'll tell you it's been the best 10 years of his life. It has, yep. And what I'm excited for you, Ken, is Ann. Ann, how long have you been selling for?
Well, technically I started in 1996, but I soon after got my appraisal license and started an appraisal company, and I got out of sales. And so I've been back in sales only for about 1.5 years.
And roughly yearly production, and where are you going to end up?
Last year was 300,000, just over 300.
300,000 in gross commission income. So nice job. That is awesome.
Thank you.
Rocket ship. So what we want to talk about today is how do we offset some of that? So brought in 300,000 as an independent contractor, as a kick-butt real estate professional. Ken has helped me throughout the years offset some of that taxes through owning real estate. So with that being said, Ken, you know a little bit about Ann and her experience and what she has coming in from her sales. What are some advice that you would have for, I'm a big fan of purchasing real estate and depreciation, taking advantage of those things. As you know, you've helped guide me through that. What would be some advice for her?
Okay, I would be remiss. Congratulations on your success, Ann, and anybody else watching this. So obviously you're a small business owner, and you're getting that commission income, probably running a Schedule C. So of course you got all those expenses like meals and entertainment, travel, car, all those kind of things that you do. I'd be remiss if not to mentioning a SEP plan or something like that, where you can do your profit sharing set aside. That's obviously a good thing. But then what Caleb was talking about is buying basically buying rental real estate, where you make money in the real estate is on the purchase up front, right? Yes, it'll appreciate, and you get cash flow from leasing it, but if you can strike a good deal up front, that's and then what Caleb has done is been able to buy, more going into commercial at this point, buy and then secure tenants, and take something that's maybe a little less desirable, and then having the vision to turn it into, with some some paint and some upgrades, something very, very profitable that people out there can't do themselves. Okay, so I think that's really where Caleb has made done very, very well, is finding those diamonds in the rough, cleaning them up, and for as minimal as he possibly can, and make them presentable properties that fetch good rents when people come by and want to move in and run their business. Okay, along with that, you purchase the real estate, and you have an allocation to land, and the rest is the physical depreciable property are eligible for shorter life than the 39-year commercial life of a building, or 27.5-year life for a residential structure. Okay, so you look within those, and it's called cost segregation, where we pull out the shorter life property. Anything outside of the structure, driveway, sidewalks, things like that, they're all landscaping. Those are 15-year pieces of property, 15-year elements, and a lot of the things inside that are either decorative or movable, or replaceable like carpet, cabinetry, decorative lighting, all kinds of things, signage, stuff like that. Those are eligible for 5-year write-off, okay, initially. Okay, 5-year property, 15-year property, as opposed to 39 and 27 and a half. But the big plum in the depreciation world is all that stuff, anything that has a life of less than 20 years is eligible at this point for bonus depreciation. And you're able to write that off over in the initial year of acquisition and placed in service. Okay. So if I take $100,000 piece of property and I allocate $15,000 to land, which is non-depreciable, now I got 85 grand left. And if I can peel out 15 to 20% of that project in 5 or 15-year property, okay. So, I'm looking at, 15 grand to 20 grand immediate write-off in year 1 on that $100,000 property. So, if you take that to $1 million property, you're looking at $150,000 to $200,000. Okay, those are significant write-offs. Okay.
Yeah, and does that make sense what he's talking about? So when you own a piece of real estate, you get that, typically they give you that long, I forget the years, 27 years for depreciation. But what he's talking about is they allow you to squish it up to where you can take advantage of it during your high income years like you have right now. And this is what I've personally been taking advantage of, and Ken's been helping me through that process. But like, you buy the property, they allow that, that certain amount to be depreciated, and they squish it up. So now instead of you having a $50,000 tax liability, you could have a $25,000 tax liability for the year, depending on what property you buy in a lot of different pieces. But
so for instance, I bought a duplex and closed on that in September.
Okay.
So for 2020, I would be able to claim some depreciation on an accelerated amount of depreciation, as well as 2021. I would be able to claim some accelerated depreciation.
Yes, that's exactly it. But see, the 2020 in the year of acquisition, just again as the example, you bought the duplex for $100,000. You allocate 15 grand, say, to land. You can't depreciate that. So okay, now you've got 85,000 in the structure, right? Normally, a duplex is residential rental, so you'd depreciate that over 27 and a half years, straight line over time. Okay, little bit of depreciation each year, right? Okay, but if we can take, as part of that 85, if we can take 15 grand of elements inside there that qualify for shorter life, okay, that allows us to take bonus depreciation, which is that first year write-off, all in year 1.
So it's a massive tax advantage. That 15 grand now is not the 15, you don't have to pay that in, and that they swap that out. So that way you're paying that much less in on your taxes because you owned real estate, right?
Right.
So so the question should be, what do you think your tax liability is going to be, Ann? And then you decide if you really want to own a lot of real estate, especially if you want to own a lot of real estate during your high earning years. This is what I'm doing. I believe in the product we sell all the time. And so I want to buy and own and retain a lot of it, take advantage of those depreciation, keep that cash in my pocket to go buy more property, and then just keep repeating each year to offset that large tax liability. I mean, your tax, we can't speak because we don't know exactly what your tax liability would be, but it could be upwards of 90 grand.
Okay, that 15 grand that I said we take all in the first year, now that's fully depreciated, right? So you got $60,000 left to take over 27 and a half years, okay? That's the building proper, that's how that works. So you take a big block now and you take less over the future years, okay?
Now, does it matter if there's a mortgage on the property?
No, not at all.
Okay.
No, you own it. So that's the more beautiful thing. So you're putting little money into the property and taking these large write-offs, okay, up front against, And now, of course, that property the next year has, if you do that, and you might have taxable income the next years because you've taken that block of depreciation. But if you're ascending and building your real estate empire, you buy one property this year, you buy two next year, buy three the year after that. So as the initial ones are, you've taken the depreciation, so they're becoming profitable. You're buying the new ones that are offsetting the income on the older ones. Okay.
For this strategy to work, two things have to happen. Number one, well, you got to just keep earning money and building, right? You got to and you don't even have to make money to take advantage of this. You could actually technically be losing money in what you tell the government in terms of depreciation and these things. Like you could be going backwards technically on your tax amount that you need. But if a good strategy with this, and the reason that I'm doing this personally is because I believe that our investments and our business are going to keep growing. So we're going to continue to earn more and more each year. And then the second thing is I just personally want to own a lot of real estate anyways. And there just happens to be this great benefit of this accelerated depreciation to take advantage of. Each year that those go up, we just keep adding more and more real estate to our portfolio, which we believe is for a healthy company anyways.
Does there come a point tax-wise or any other aspect, I guess, when it's a good time to sell, when that property is no longer necessarily serving you or benefiting you? Is there a certain point? Is there a certain, is it fully depreciated after so many years and it's good to sell it before that or at that time? Or
well, again, what you've taken that big block of depreciation up front. Now, notably, if you go down 5 years down the road, you've taken more on the front end, so that'll equate to more tax on the back end. Okay. Because you've accelerated your deduction. Okay. Now, the way you look at that is one time where we maybe not take that strategy is if depreciation or if income tax rates were very, very low and they were going to shoot up. Okay. So we're watching this right now, but the typical is, and the way Caleb has done it is saved a lot of money, which allowed him to accelerate into purchasing more. Instead of sending money to the government, he retains that money, he buys more properties. The government is subsidizing his ability to buy more properties, knowing at the end, because we've ran numbers, he was looking at potentially doing just that, selling some properties, and he looked at the tax bite at the end and said, well, I'm going to hold them for a little while longer. Okay. But you're right. I mean, it's pay now or pay later, and it's about getting money in your pocket now so you can do something positive with it versus sending it to the government and then send it to the government later.
She's in her higher income earning years right now. So one thing you gotta look at, Ann, is for the next 10 years, if you're gonna keep going like this with your production, there might become a time where you slow down, right? And you want all that depreciation during those high earning years because you're not gonna make as much in the future at a certain point, let's say where you're not selling as heavy. And at that point, then your tax liability shrinks and shrinks and shrinks. So it's a really good advantage for a growing business.
And then in the future, you're looking at selling at potential capital gains rates, which are lower. You're getting appreciation. You're using other people's money to create appreciation in this property that you bought. And then you're able to sell it at lower capital gain rates in the future or lower ordinary income rates in the future, as Caleb mentioned. The other things you can do is you can actually physically sell in the future and then trade into different real estate. So kick the can down the road even farther. That's called a 1031 exchange.
And the Starker exchange?
Starkers, yeah, Starkers. Okay, where you just lower the basis in your replacement property and defer the gain into the future. So that's a technique that a lot of real estate people use. Sell a couple of duplexes and get into an 8 unit, or sell multiple duplexes and get into, something bigger and move up.
Like if I owned, say 4 duplexes and down the road wanted to purchase a home in another state, would I be able to do an exchange for that? And not an investment property, but a single family property that I could rent out at time, that I could rent out at times, but I could also use myself.
Here's how that works. It's 1031 is strictly for trade or business or investment property. So
Okay.
you can't do it for a vacation home, and certainly you can't do it for a residence that you're going to use as a second residence or something. But what people will do, and there's some rules in place that say if you're going to trade from a Wisconsin business or duplex type property, you can go to Florida and buy a condo, and I've had people do it. You've got a 2-year hold where you do not use it personally for 2 years, other than there's a 14-day rule, okay? But you treat it as a rental property for a full 2 years, 24 months, and then you could flip it over to a vacation type rental or a second home kind of thing, and you're absolved of that. So there's a way to do it. There's a way in a longer holding period, but it can be done.
Yeah, what a great strategy. Try to buy 4 properties, roll them into, that, an Airbnb or a condo or something, but just do it per the rules of the tax code. And I think you can accomplish that. This is why you need a really good tax accountant, especially a real estate accountant right here for helping you realize those dreams that you want to make happen. Ken, the question I have that a lot of people might be thinking about is for cost segregations, or for okay, if you have 4, let's say that Ann bought 2 or 3 properties, at what point does a cost segregation make sense? Can you do it on how expensive was your duplex, Ann?
It was 160.
The 160. Can she take advantage of this with that?
An official cost seg study, no, but there are, on the bigger buildings, you want that professional bulletproof study with the, upon audit, the federal government's going to look at it, IRS agents are going to look at it, and you've had a professional do that, do that engineering study, okay? But on the smaller property, and those are for properties typically, with the bonus depreciation, 750,000 and higher is where you'll do those. But all these other properties below that, your duplex that you just bought has certain elements. So, so there are pieces that we know are there, and we can carve out and do carve out for clients. Okay. Now we don't, so you just be somewhat conservative on it and do something, and whether or not you're going to get it audited is never a defense. So, but this is being recorded. I'm being totally honest. We do it. We pull out those pieces in residential properties, and we know there's a driveway there. We know there's sidewalks and landscaping. We know there's cabinetry and carpet inside. So we do get, and we've done these studies for all these, apartment buildings and things like that. So in my head, I know what those, what those factors are in a buy, and what, close to what the percentages should be. So, we do unofficially break those properties down and take those depreciation elements and get those results.
So you're saying is on a smaller price home, it's more of like a quick analysis that's done by the accounting firm, and then on a very expensive, million plus, you actually get a full-blown engineering report. It can cost anywhere from a couple thousand bucks and up for the full-blown report, depending on how big the property is, because an engineer goes out there, they look at every single thing, and they document every single thing of that property to make sure that they meet the government guidelines of what is acceptable and what's not.
You naturally get more or a better result by having that full-blown study done. But for a $160,000 duplex, you don't want to spend $5,000 on a cost seg study, because, you know, just economies of scale, the bigger properties, you know, you have to do the same, you know, similar work, but for smaller pieces. Just like a tax return, you have somebody that makes $2 million versus somebody that makes $100,000. The same elements go into a tax return preparation, but the numbers are just bigger, right? So you got to do the same formality.
I want to summarize this a little bit. You guys, this strategy is for high income earners. So you're earning a lot of income in your job or in your sales business, right? You're selling a lot and you're earning a lot of commissions. You plan on holding real estate investing as a part of a passive income approach to your business. The third thing is that this does not forgive a bad purchase. So if you're going to go buy a bad real estate deal, this might help you a little bit, but it's not going to help you that much. You have to make sure that you buy really good investment deals first, and then this is just a bonus thing right after the top on top of that, and then you get after the strategy and start cutting down some of that tax liability that year that you can then go and reinvest in more properties over time. So
yes, exactly. And obviously the benefits are, you know, you have cash flow coming off of these investments, and you have pay down of your debt with that same money, and then you've got appreciation over time, and then you have the ability potentially to roll those into bigger, better properties, you know, on a tax efficient basis if the tax laws hold the way they are not right now. So it's a good time to buy real estate at this present time. Caleb has hit on all the points of the strategy, and your day job allows you to probably purchase more properties too and afford to take some risk because of and put some down payments and get the ball rolling a little quicker than you know, somebody who's making 50 grand in commissions, let's say.
Well, thank you both for spending some time with us today to talk about the tax advantages of owning real estate when you're a high income earner inside of real estate and you're a real estate professional. So thank you both.